Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the markets analyst here at HFM Markets. Today, I'm going to be looking at trading in general. We're looking at trading for beginners. But before we start looking at today's topic, very quickly, I want to wish everybody a happy new year. Hopefully, everybody had a Merry Christmas, great New Year celebration. And hopefully everybody's ready for a new year of investments and trading. People that have been trading over the past 48 hours that the markets have been open this week, hopefully they've been enjoyable and successful. But today, ladies and gentlemen, because most of November and December, we're looking at slightly more advanced webinars, not too advanced, but looking at strategies, looking at entries and exiting the market, looking at the timing of trades. Whereas today we want to take a little bit of a step back. We've got a lot of new traders, a lot of individuals that have never traded before, and we want to look at a simple and fun webinar where individuals that have never traded before or are interested in trading but don't know enough about it to start trading, to really look into the financial trading market. So today's webinar is going to be slightly easier, it's going to be fun, it's going to be more enjoyable. People are going to get a great understanding about the financial trading market without, of course, going into more advanced aspects of the market. So it's a great webinar for individuals who are new to the market. But of course, if anybody does have any questions, if anybody is a more experienced trader or somebody that has been trading 1 month, 3 months, 4 months, and they have questions or certain scenarios or certain stories that they want to share and get more information on, then of course everybody has the option to ask questions through the GoToWebinar software. And of course I will read the questions out live, I will answer the questions live as well. We'll do answering questions approximately every 2 slides. Now, this other thing I wanted to mention before we start looking at the topic is that, as I mentioned, yes, it's an beginners webinar, so we're not going to be looking in too much advanced aspects of the market, but what we're doing is we're giving a strong foundation and a stepping stone for our future webinars. So for example, we may be looking at the basics of analysis, we may be looking at the basics of trading, of a trading plan, of risk management plans, but we're not going to go into, for example, actually designing a full-blown trading plan. So it's just a stepping stone, it's an introduction, and it's a great foundation in order to register for our next webinars where we start to go into more detail. So for example, this month we have a webinar based on scalping, strategies of scalping, techniques of scalping, risk management specifically designed for this methodology of trading. Today, we're not going to look at something so advanced, but we're going to build a nice foundation and understanding for our beginner traders. Now, before we start looking at that, just 2 slides, very quick slides as an introduction. What I want individuals to be aware as part of this slide is that, of course, when we're looking at trading, as with all investments, there's always a risk to the capital that you are investing. Why? Because you are investing in an asset, and the performance of that investment will depend on the price in which of the asset which you are purchasing. So for example, if you're purchasing stocks, you may be purchasing gold or whatever it may be. Of course, this is outside of our control, so you have to understand this, you have to be comfortable with it before proceeding to a full investment. But of course, this is why we have webinars, because there's individuals like myself, we're going to learn a little bit about myself on the next slide, who have a lot of experience within the markets, who is not there to give investments or financial advice. Of course, we don't do this in any way, shape or form at HF Markets. But what we do want to do is give as much educational material as possible in order for individuals to be active in the financial trading markets with confidence and knowledge and expertise. So this brings us on to my next slide. Now, I don't really like this slide. I don't like talking about myself too much, but I get a lot of questions, and people, I do understand to a certain extent it is important for individuals. So I put a slide, just a couple of bullet points so people fully understand. what expertise and experience I have, which I will be sharing with you throughout our webinar series, not just necessarily in today's webinar. So, like I said, my name is Michalis. I'm a market analyst. I've been in the financial trading markets now for 10 years. I've been a market analyst for 6 years. Before that, I was a financial advisor in London for 4 years for a few companies. Some of them you may know, quite large companies in Canary Wharf, such as, for example, Platinum. So this is a little bit about myself. What I want people to, of course, do is take advantage of these sessions, take advantage of these webinars. Yes, listen, take note, learn, but at the same time, anybody that has been trading or anybody that has questions, ask questions live, because I will answer the questions live, and also other people will be able to hear your questions and hear the answer to the question as well. So we're all helping each other at the same time. Of course, I will not expose any sensitive information such as your name and so on and so forth. I can see a couple of questions already, but they're questions which really we're going to look at under certain slides. So let's go to that slide and then I will answer those questions if they're not already answered on the slide itself. Now, first things first, we want to start off very, very basic for individuals that have never traded before, such as, for example, why are people trading? Why are people investing? What is trading? Some people say trading. Some people say I'm investing. Is it the same thing? Is there a difference? What are people doing in order to profit? Why are people not seeing profits? So these are the aspects that we need to look at as part of our introduction. So to answer the first thing that I said, is trading and investing in the same thing? Because throughout our webinars, I keep getting this question asked, are we looking at investing or are we looking at trading? What is the difference between the two? So investing and trading is similar. A lot of the time it can get confused. People can get confused between investing and trading, but it is slightly different. Even though trading is a form of investment, if you are trading, then you are investing, but there is different characteristics between the two, and it's very important to understand that there's a difference and there's very strong different characteristics of the two. It's important to understand this because a lot of people are doing research, they're watching videos on YouTube, they're reading ebooks, and they may be looking at a strategy, they may be looking at an aspect, for example, of risk management, which is appropriate for investing and building a portfolio and a longer term investment, but it's something which is very dangerous, for example, when you are trading. So it's important to differentiate between the two. But either way, whether you are investing or whether you are trading, it is an investment. We cannot get around it's being an investment. It is 100% an investment, which is why it's such a great thing potentially as well. So what is an investment? To go even more simple, an investment and investing is very simply when you are buying an asset, or you may not be buying an asset, you may be putting your money into something with the expectation that it's going to generate profit. Now, I guarantee you, everybody here who is watching today's webinar has made an investment, even if they knew it or not. So for example, anybody who is, for example, savings, if anybody has a savings account, the actual definition of a savings account is an investment. If you are saving, you are investing. Why? Because you're putting your money into an account, and you're trusting that account with the bank with the expectation that it's going to pay you interest. So even though it is an ultra safe method of investing and it only has a very small return, nonetheless, if you've got a savings account, you're making an investment. Another example, if you have a current account, again, you're making an investment. If you have a pension scheme, if you are purchasing bonds, which again is another very safe way of investing. For example, bonds are part of the safe haven category. then of course it is a form of investment. So whether you believe it or not or knew it, everybody here who is watching today's webinar, we have over 400 people registering for today's webinar, have made an investment. So an investment is when you're either buying an asset or putting your money into a certain scheme or product with the expectation that it's going to generate profit. Now, the key difference between investing and trading is very, very key. When you are trading, you are actually continuously active in the financial trading markets. So this is why it's known as trading, because you are purchasing, selling, purchasing, selling. So it's a short-term investment, you are continuously active within the market. Whereas if you're investing, even though trading is a form of investment, when people say investing, you're actually looking most likely at longer term investments, even though an investor can be looking at occasionally short-term options, medium-term options. When we're referring to investing within the financial trading markets, we're mainly looking at longer term investments, most likely individuals looking to build a portfolio. So they may have a specific target to say that I'm going to purchase an X amount of a certain product or asset. It may be, for example, a stock. Or stocks, should we say, and I'm going to do so for 10 years, and I have an aim at the end of 10 years to, for example, pay off my mortgage earlier, or, for example, have some for retirement and a pension. It could be for multiple reasons. It could be for my child's education or wedding, whatever it may be. So it's a longer term investment, building a portfolio, investing for the longer term with a specific target and aim. Whereas if you're trading, you're entering and exiting the market, entering and exiting the market. So you're more active within the financial trading market. So this is the major difference. So this is why I say on point number 5, trading is when an investor buys and sells in a short period, and they're continuously doing so with the aim to earn a quick profit. Whereas longer term, you're not looking for a quick profit. Now, trading is also normally associated, not all the time, it's normally associated with something which is known as leverage that we're going to look at in a couple of slides. But this is a very strong characteristic of trading compared to when you're an individual is building a portfolio. When you're trading, most of the time, individuals, they are using leverage. Now, of course, here at HF Markets, because we are very strong in our belief that investors should have full control over their investments and what they're trading and how they're trading, we of course give full control to you as an individual. So individuals can trade with leverage, they can trade without leverage, it could be a high leverage, a low leverage, whatever it may be. So then we now understand what investing is. We understand that we are also trading and the difference between the two. But what are we trading? What categories is there? What assets are there? What characteristics are there? And this brings us to today, one of the questions we had today, which is what has been one of the best performing assets of 2023. So I'll get to this once we look at this slide here. So the first things first, Forex. What is this category? So keep in mind, this first row here, we're looking at the category. We'll describe the category so everybody fully understands what the asset is. And then we'll look at correlations. Now, what does correlations mean? Correlation means links. In a very simple way of understanding it is what is influencing that asset. Because as traders, what we need to do is we need to be able to determine, to predetermine how the market is going to move before the actual market movement happens. Now, in order to know this, we need to follow certain methodologies in order to establish this. Now, one of these is, for example, technical analysis. Another one is order flow analysis that we're going to look at later on as part of this webinar, which looks at how to determine how the market is going to move. Another thing is, of course, what is influencing investors to make certain decisions within the market. So if I'm a shareholder, what will actually cause me to sell my shares? Because if I'm selling my shares and that aspect of the market that has influenced me to sell my shares is actually triggering everybody else to sell their shares, then if everybody's selling their shares, there is a high possibility that the price will decline. Now, some people may say this is a bad thing. It's not necessarily a bad thing. What it actually means is the price is declining and there's volatility, which gives us the opportunity to speculate and potentially earn on that downward price movement. So this is a very good example. Another thing is, for example, if there's a strong sell-off, everybody's selling their shares and there's a stock market crash, people think a lot of the time this is a very bad thing. Whereas actually hedge funds, mutual funds, very rich professional traders actually love stock market crashes. Warren Buffett famously has said, and also George Soros has continuously said that a stock market crash gives amazing opportunity within the market. Now, somebody can be trading and looking to speculate the decline, and of course, it gives us that volatility and that option. But at the same time, even if anybody's looking to build a portfolio, build a longer term investment, if there's a stock market crash and everything has declined by 35%, why is that a good thing for all these individuals looking to start a portfolio? If everything has declined by 35%, ladies and gentlemen, it gives you as beginners the opportunity. Of course, it's down to you. You need to make your research, do your analysis and determine when is the best price to enter, but it gives you the opportunity to purchase at a much more competitive price. So for example, if we look at the past 20 years, well, let's not go so far back as 20 years, let's say 16 years, there's been 3 stock market crashes. There was a stock market crash in 2007, 2008 because of the banking crisis. There was also one in 2017, 2018, which was only a minor crash, but nonetheless it was a stock market crash because of the trade wars between the US and China. And there also was one in 2020 in COVID-19, which was again short-lived, and then again in 2022. If you look at each time there's been a stock market crash, what has it done? It's just given individuals the opportunity to purchase at a more competitive price. It's like, for example, if we look at the NASDAQ now is worth about $16,500 US dollars. Would you rather buy at $16,500 US dollars, or would you have rather have been the individual that bought just after the stock market crash where it was hovering at, for example, 10,000, 11,000, whatever it may have been? So correlations are very important. We're going to be looking at this as well. What is influencing the price of the asset? Now, I've spoken a lot, I've raveled a lot about this, but today, like I said, what I really want to do is concentrate on just the basics and build a foundation so that in future webinars, we will select one topic instead of trading in general, which is a very big topic. We'll select one topic, for example, one form of analysis, one strategy, and we'll spend a full hour looking at that so people get a strong, good understanding and knowledge on how to actually do it themselves. So first things first, let's leave that and go through the categories. So Forex, what is Forex? Forex, ladies and gentlemen, very simply just means a currency exchange. Now, some people may say, how can I buy a currency? So when you've got stocks, for example, you have stocks, it may be, for example, Apple stocks, which has been in the news a lot. Excuse me, in the news a lot over the past 48 hours. Why? Because the sale of their iPhones has significantly underachieved. Also, the recovery from the MacBook, from the iPads has been very poor, according to reports. And because of this, they are expected to be underachieving. And of course, that has caused a lot of shareholders to actually sell their shares. And it's created yesterday, for example, the Apple stocks actually to decline by 4%, which is a significant decline. It's also declined today as well. When you're looking to buy an Apple stock, people buy it with a currency. So some people say to me, how do I invest in a currency? How can I buy a currency? Because I have a currency. You know, if I'm in Europe, I've got euros. If I'm in, for example, Singapore, I've got the Singapore dollar. So how can I buy a currency? This is why we have currency exchange rates. You buy one currency with another currency. So people are used to, when they buy something like an apple, should we say, they've just got the price of the apple, whereas actually it's a pair. It's the commodity in a value of a currency. And the same thing applies for a currency. It will be one currency has a value against another currency. So for example, the most traded currency in the world, ladies and gentlemen, is actually the euro. Please ignore my handwriting because I am using a computer mouse. So for example, here we've got the euro against the USD. So it's basically saying to you, if I want to buy 1 euro in USD, how much USD will I require? So how much is required, ladies and gentlemen, in one currency to buy another currency? So this is very simply what Forex is. It is two currencies paired against each other, and it's the value of one currency against the other. And of course, what is creating volatility and what is driving the price is supply and demand, which is the case with most assets. I've got another question. Will the PowerPoint be available? Yes, of course it is. And you can also speak with our support team and they can provide the PowerPoint for you as well. So what is the correlation? So what is having the biggest influence on the price of currencies? Now, the first thing, and this is something which not a lot of people look at, is bond yields. Bonds, I'm not going to explain just yet because we've also got it here as a category, but bonds, ladies and gentlemen, is a form of investment which is either released by the government or released by a very large company. And what they're basically looking to do is they're basically looking to borrow money and they will pay you an interest. If they're paying you an interest, then of course this is a yield. This is what is known as a bond yield. Very simple terms, it is profit. So for example, they say to you, if you buy a bond worth $100, we'll pay you each year $5, which means it's a 5% yield, 5% profit per year. Now, bond yields has a big effect on the currency. Now, if bond yields are increasing in value, what it actually does is it causes the currency to increase in value. Why? Very simply because if I'm in the UK and in the UK bond yields are, let's say for example, 2%, which is on average what bond yields tend to actually give as a yield. And in the US, the bond yields have actually increased from 2% to 4%. Am I going to keep on purchasing UK bonds, which are known as gilts? Or if I've already got them, will I keep hold of them? No. If they're paying me 2%, in America they're paying me 4%, I'm going to sell my UK bonds and I'm going to buy US bonds. If I'm buying US bonds, I need US dollars. So when bond yields within the country increase, there's more investors attracted to that currency, to that asset, and to that country. And of course, as that happens, the price increases in value. And I've got another question. This is a great question. How can I see bond yields? I'm guessing you're referring to what the bond yields are at within each country. This is a great question. I will answer this at the end of the webinar. I'll actually go on Google and show you very easy ways of seeing what the bond yields are. So in simple terminologies, the traditional correlation is when bond yields increase, the currency increases. When bond yields decrease, the currency decreases as well. Risk sentiment. So what is risk sentiment? It means the sentiment everybody has towards risk. So if people have a high risk appetite, it means they're really looking to invest and be adventurous and look at different investment options, even more riskier investments in order to earn a return. Whereas if people have a low risk appetite, people are not willing to risk. Now, if people are not willing to risk, what do people tend to do? They keep cash. They keep cash, they keep their money and their savings in the bank. And what this does, of course, is it means nobody's interested in stocks, nobody is interested in cryptocurrencies, on ETFs, they just want cash, which is certain and is safe. So this, when there's a low risk appetite, it triggers currencies to increase. Where there's a high risk appetite, currencies a lot of the time tend to decrease. Interest rates. Interest rates, ladies and gentlemen, I can see another question, I'll answer it in a moment. Interest rates which are selected by the central bank. When interest rates are increasing, the currency increases as well. And it's the same reason for bonds. If savings accounts in America are higher than savings account in Europe, why am I going to stay within Europe and keep my money? If I'm a very high net worth company with $1 billion, why am I going to keep that $1 billion in a savings account in Europe when I can actually keep it in a savings account in America with higher interest? So this is why interest rates are important. It's the same thing as bond yields. It has this correlation. Inflation is important because it has an effect on interest rates and has an effect on bond yields. So if inflation is high, interest rates increase. If inflation is low, interest rates tend to decrease. And then, of course, you've got the economic outlook. If everybody's investing and the economy is doing very well in, for example, Japan, then, of course, the value of the Japanese yen will also increase because there's a lot of demand in that specific region. So hopefully now everybody's got a basic understanding. I can see a lot of questions. Please bear with me because I don't want to stop every couple of seconds, but every single question, ladies and gentlemen, will be answered. So people now hopefully have an understanding of Forex, what is Forex and what is influencing it. So let's move on to stocks. Stocks, ladies and gentlemen, if we ignore currencies, because currencies are also used for other reasons, not necessarily just investments, whereas a stock is just clearly an investment. Stocks are actually the most popular form of investments in the world, ladies and gentlemen, and it has been for almost 100 years. So what is a stock? Stocks, ladies and gentlemen, is very simply a part ownership of a company which is being bought on an exchange. So there's two types of stocks. There's preferred stocks and there's also common stocks as well. It's very simply just a part ownership. It's a percentage of a company that you have bought. So I don't want to spend too much time looking at that because it's, generally speaking, a household term. Most people know what a stock is, but if somebody doesn't, that's what it is. It's a percentage of a company. It's an ownership of a company. Of course, that's got a value. It's following the theory of order flow. That's how it's priced. So in simple terms, again, that is supply and demand. Now, stocks are influenced by the same things as currencies, but tend to be the opposite. And the only difference is there's an additional form of influence, which is the company performance. Now, if a company is performing well, they're earning profits. Each quarter, they're earning more profits. If you're a shareholder, most likely you're going to be unwilling to sell your shares. Why? Because it's a safe investment, because they're earning more than they had before. The next quarter, they're predicted to earn more. So you're happy as a shareholder, you feel safe, you feel like there's potential, you will not sell. Because of that, the price of the stock increases in value. And also because of that, more people are tempted to buy. And again, price increases. So the performance of the company is a very big factor. But though you also have bond yields. Now, the difference, ladies and gentlemen, is bond yields, monetary policy, which is interest rates, and inflation. When these are high, stocks tend to crash. Whereas for currencies, when these are high, the currency increases. So this is why I said it has the opposite effect. Why? Because when bond yields are high, interest rates are high, and inflation is high, consumer demand tends to be very low. So these companies are likely to perform worse than they previously were. And also, in addition to this, the possibility of a recession, if there's high yields, high inflation, high interest rates, is significantly higher. And again, for this reason, people tend to avoid stocks. A very good example of this, ladies and gentlemen, is 2022. We had high inflation. We had the highest and quickest interest rate hiking cycle that we have seen in over a decade. And because of this, for example, the NASDAQ, it declined by, I think, just over 33%, just over 33% in a space of 10 months. So this, ladies and gentlemen, is a very good example of how that influences the market. Then we have indices. What is indices? Indices is a group of stocks which have been grouped and pulled together to make one asset, one fund, and also one price. So for example, the NASDAQ, the S&P 500, the DAX, the Nikkei 225, and so on and so forth. This is again also very popular, especially with CFDs as well, which we'll look at on the next slide. Exact same influences. I'm not going to go through it. Why is it the same influences? Very simply because the price of the index is being driven and influenced by the price of each individual stocks. So if there's 100 stocks within the index, like the NASDAQ, of course, the price of the NASDAQ is determined by those 100 stocks. Commodities, very simple to understand. We have energy assets like crude oil, Brent oil, natural gas. We have metals such as silver, palladium, gold, and then you have agriculture like livestock, cocoa, sugar, corn, and so on and so forth. What is driving these? The economy, monetary policy, fiscal policy, politics, and environment. Why are they being driven by this? The economy is simple. The better the economy does, more people buy. Monetary policy is like what I said before. Higher the interest rates are, higher the inflation is, the worse the economy will be. So it's the same influence here as well. Then politics and environment. Why is this different? Why is this not included in the previous ones and it's included in commodities? Politics, for example, a good example of this in 2007, 2008, we had US-China trade wars. This was only thing that everybody was speaking about. Why does this create volatility and causes the price to move in certain directions? Because it means these two countries are not willing to do business anymore, or if they are willing to do business, they'll rip the other country off. What do I mean by ripping them off? They put tariffs, they put taxes, and it becomes very unattractive to buy those assets. So for example, if I'm in America and I buy apples from China, and all of a sudden President Biden comes along and says, we're no longer going to buy apples from China, it means there's going to be not many apples left in the US. So instead of me having to buy apples for $1, I'm now having to buy them for $6. So this is why politics and environment is included as part of the correlation here. Then we have ETFs. ETFs are not the same as indices. I've got an individual here. I saw the question, I didn't mention it. Are indices the same as ETFs? They're not. They can be similar, but they're not. And ETF stands for exchange traded funds. So it is like an index and indices, which is basically a fund. It's lots of assets pooled into one asset, which is a fund. So there is this similarity, but an ETF is actually traded on the stock market. And also an ETF can be different things which are pooled into the fund. Whereas if you look at indices, it's only stocks. Whereas if you look at ETFs, you can have an ETF for commodities. We can have an ETF for cryptocurrencies. For example, BlackRock is, and also Goldman Sachs is believed to be looking at options and trying to create an ETF for cryptocurrencies. So this is a very good example as well. So this is the difference between the two. Is it stocks? It can be an ETF and it can be an index. If it's something else, it cannot be an index, it is an ETF. Now, what is correlating with the asset will depend on what is included within the fund. So if we've got currencies, a group of currencies in the fund, then of course we're looking at this here, ladies and gentlemen. Let me get my pen out. In that case, we're looking at this here. If we're looking at different stocks, we've got this influence. If we're looking at different indices, we have this influence, commodities, this influence, and so on and so forth. Also, bonds are very popular a lot of the time as part of ETFs as well. Now, what are bonds? Bonds are fixed income investments, which are either issued by the government or issued by companies. So a simple way of understanding it is, for example, the government in, let's say, one of our African regions, let's say South Africa, the government in South Africa may say, we want to build a highway from Cape Town to Johannesburg. This will cost $1 billion US dollars. We don't have $1 billion US dollars, so we need to raise it. So let's go to the bond market. We'll issue $1 billion worth of bonds. We'll pay them back over the next 10 years and we'll give them 2% a year. So this is why it's a fixed income investment. The asset still has volatility because people will continue to buy and sell, buy and sell, buy and sell. So it's still driven by supply and demand, of course. So let's move on to the next slide because we've been speaking now, ladies and gentlemen, for 36 minutes. So we've still got a lot of slides. I don't want to go and spend too much time. I've got some questions, so let's quickly go through these questions, ladies and gentlemen. Bear with me. So I've got another question. So somebody else is asking if they can have the slide. Yes, of course you can. Please, how do I start? Ladies and gentlemen, go to the HFM website, click on register, and the step-by-steps on how to start. It is very, very easy on how to start and create accounts and become a trader. Also, there is an option, education. Under that, there's webinars. There's lots of webinar options there, ladies and gentlemen. You can go to our YouTube channel. There's a lot of educational videos. Take some time, do some research. There's a lot of material there, really can help you on how to start. And also we have a demo account, which is a practice account, which again is very important for beginners. Another question, the decrease and increase in the Forex assets as a result of correlation in terms of price or value. What do you mean by this? This is a statement, so it's not a question. I won't mention your name, but if you can rephrase, because I need it to be a question rather than a statement. And that's the last question, I believe. No, we've got one more. What is the difference between the indices and Forex? Completely different. Forex, we're looking at currencies. Indices, we're looking at stocks. So hopefully that answers the question. So understanding CFDs and leverage. So why we've looked at investing, we've looked at trading and what that is. We've looked at what we can trade. So why have I now gone to something which is called CFDs and something which is called leverage? Because CFDs is the way here at HFM Markets that you can invest in stocks, that you can, when I say invest, I mean trade the price movement. And we can trade the price movement of commodities because, of course, you cannot just go on the website and order gold and a gold bar is going to come to your doorstep. So we actually need a way in order to be able to actually purchase or to speculate the price movement or to buy at a certain price and sell at a different price in order to benefit from these assets. Yes, we've understood trading, we've understood stocks and so on, but how am I going to trade it? And the answer to this is we offer an asset which is known as CFDs. What is CFDs? It sounds really confusing. CFDs is an asset and is an abbreviation for contracts for difference. What is a contract for difference? It is a derivative, and I guarantee you, you're still confused. So let's break it down. Simple, easy, fun way of understanding it. What is a derivative? A derivative is an asset which is not a real asset. It is not, for example, if you've got a derivative in gold, you're not buying gold. You're not going to get a bar of gold come to your door. If you're buying a CFD or derivative in oil, we're not going to send you a bottle of oil or a barrel of oil. It is not the real asset itself. What is it? It is an investment contract. It is a contract between a platform, the broker, it could be a liquidity provider, and yourself. So it's a contract which has a value. So for example, the CFD, the derivative, is mimicking the value of an asset. So instead of having to go and find gold or somebody who's selling gold, we come and we say an ounce of gold is worth 2,000 US dollars. So you've got an ounce of gold here, the real thing worth 2,000 US dollars, and then we have the CFD. So it's not gold, it is an investment contract which mimics the price of gold. It's going to follow the price of gold. So if gold goes up and if it goes down, it is the exact same. The price movement will mimic each other. So because of this, ladies and gentlemen, people are actually able to benefit and speculate on the price movement of all these assets without having to actually own the physical underlying asset itself. So this is what a derivative is. It's when individuals buying a contract on asset which is mimicking the value of the real underlying assets. So this is what a CFD is, and this is what a derivative is. So this is why I say here CFD is an asset which allows individuals to speculate the price movement of an asset without buying the real thing. So for example, I'm an individual who says, I'm going to buy a CFD here at this price, and I'm going to sell the CFD at this price. And the price does something like this. And at this point, I will sell. The difference between the two prices may be $10, so I've earned a profit of $10. So again, it's the same as the real asset, but you're not buying the underlying asset. You are buying a derivative. Now, some people may say, why will I go to buy a derivative instead of buying the real asset itself? Now, it's very easy to understand if, for example, you're looking at gold, oil, because it's very difficult to be able to invest in the physical asset, physical gold. What is everybody going to store gold within a safe box at home? Very difficult, very unlikely. People won't do it. So it's very easy to understand why people look at derivatives there. But why do people look at derivatives with indexes, with currencies, with stocks, with ETFs, with bonds? And the answer to this, ladies and gentlemen, is there's certain benefits to derivatives. Now, these benefits may make the assets more appropriate for you and more attractive for you, or it may actually say to you, it's a good option, okay, I've considered it, but I think the real thing is actually a better option for me. And this is down to you as an individual, of course. So why do people, instead of buying the real underlying assets, instead of buying that, why do people prefer to invest in CFDs? And the reason is the following. CFDs tend to be a cheaper option. When you're trading CFDs, the only thing that you're being charged is a spread, or we have an account which has lower spreads and instead has a commission instead, and an overnight fee. CFDs, trading, as we mentioned, short-term investments. Most people don't have the trades open overnight a lot of the time. So again, they're not even being charged that. So it's a cheaper option compared to actually investing and buying the physical assets itself, which depending on the assets, can be potentially quite costly. So this is reason number one. Reason number two is very easily accessible. So if you're in the stock market and you're buying and want to buy a stock, you actually go in the queue. Depending on what the demand is and how many orders within the market there are, it can be quite difficult sometimes to buy a stock. And sometimes there can be a lot of slippage as well. Now, because of this, CFDs are an easier option. Why? Because you're not physically buying the underlying asset. You are just speculating on the price movement. So if you click buy, you will instantly enter the market. If you click sell, you will instantly exit the market. Whereas if you're looking at a stock market crash, okay, for example, back in 2022, what is the issue if anybody has bought the stock? The issue is nobody wants to buy it from you. If you buy the physical stock itself, somebody needs to be there willing to buy it from you. If nobody's willing to buy it from you, then the stock will collapse, it will keep collapsing, and you'll be stuck within the investment. Whereas if you're looking at a CFD, you click sell, you click exit, and again, because nobody's buying from you, you instantly exit the market. So these are the main benefits. The other benefit, which is a very big characteristic of CFDs and also derivatives as well, is something which is known as leverage. I can see another question. Let me quickly answer this question. Bear with me. So I understand the question now. So do indices and Forex have an inverse correlation? Yes, ladies and gentlemen, it's not such a strong correlation compared, because you have to keep in mind correlations, they've got strength levels. You can actually go on Google and you can see the strength level of the correlations between assets. Gold and the US dollar, for example, have a very strong correlation. Currencies and the stock markets, there is a correlation there. It is an inverse correlation. It is quite a strong correlation, but it's not to the level, for example, gold against the US dollar. So yes, there is a correlation there. Why is there a correlation? Because there's a very clear influence, we call it a domino effect within the market between risk appetite. If somebody's got if the market has strong risk appetites, ladies and gentlemen, people feel adventurous, people feel happy to invest, the economic conditions are very good, people are happy to invest in that medium risk category, which is the stock market, then of course people are not interested in keeping cash, and they try and put as much money in investments, whether that's pensions, it could be the stock market. So demand for stocks are very high, currency demand is very low. Whereas if we see the opposite, people are not interested and not comfortable investing, they sell all of their investments and they prefer cash. So that's what creates a correlation, but it's not an overnight correlation, it's not instant correlation. It's a domino effect. That's why it's known as domino effect, because it takes time and it has an influence over time. So very good question. Hopefully that answers your question as well. Let's see if we've got other questions. Bear with me, ladies and gentlemen. Let's look at the rest of our questions. How can I ensure that my trade is not losing but gaining? Keep in mind, investing is not 100%. You cannot be 100% that an investment will do well. So we have to keep this out of our minds. The main thing is we have to deal with trading as a business. Each business has turnover, which are your profitable trades, and expenses, which are your trades that you have lost and closed in a minus. It's not an issue to have expenses. All businesses have expenses. The main thing is that your turnover is higher than your expenses. That creates a profitable business, and that creates a profitable trader. Now, in terms of strategy, like what options do we have in terms of how to enter, how to exit, how to analyze? It's not something we're going to cover as part of this webinar. But like I said, we can look at multiple webinars. We've got multiple webinars on our website. They're all for free. You can go to our YouTube channel as well. There's a lot of things there which give you different options, different ways at looking at having a higher success rate, should we say. A good example of things that you can research is order flow. You can also research moving averages and sentiment lines for example. So what is leverage? Just return, we've answered some questions. Let's go back to our screen here. So leverage, what is leverage? Leverage is when you increase your buying power. Now, some people think leverage is borrowing from the broker. You will see that definition all over the internet. I don't like using that definition. Why? Because nobody's actually giving you money. You are not borrowing. What we are doing is we allow you, if you wish, to increase your buying power. Now, leverage is always shown as a ratio like this. So 1 to 30, 1 to 10, 1 to 400, 1 to 1,000, whatever it may be. So leverage is always shown as a ratio. What is the ratio? It means every $1 that you invest, we will times it by your leverage. So if I invest $1 and I've got a leverage of 1 to 100, I have a buying power of $100. Doesn't mean I have $100. My $1 has the buying power of $100. So what does this mean? It means you can buy 30 times your investment. What it does mean though is that volatility is 30 times more. So keep in mind, leverage is a double-edged sword. It has advantages, it also has disadvantages because it increases your buying power, it gives you more opportunity in the market. There is potentially more opportunity and potential for larger profits, but it increases volatility in both directions. So the market can also move against you a lot faster. So for example, if you invest $100 and you've got a leverage of 1 to 30, you can actually buy a stock worth $3,000, whereas with your $100, you wouldn't be able to. So this is the massive advantage. But your $100 will move as though it's $3,000. So the volatility is more. So let's say, for example, if the price declines to 2,900, some people may say the stock hasn't declined by much. Why? Because it was 3,000, it's declined to 2,900. It's not a big decline. But because you're using leverage, you only have $100 and it's just moved by $100. You have actually gone to zero. So does that make sense? Your $100 will move as though it's $3,000. So there's advantages and disadvantages. For example, if the price increases to $3,100, which again, a lot of people say it's not a big movement, because you're using leverage, your investment has doubled. So this is why, again, a lot of people, they go to CFDs because it gives them the option of leverage. Again, I want to say to everybody, it is completely down to you in terms of what, if you're going to use leverage, how much leverage you're going to use. It gives a lot of opportunity, it gives a lot of potential, but it also is important to use it responsibly because it is a double-edged sword. It does have that disadvantage of creating additional volatility. So a trader's aim, and I don't spend too much time on the trader's aim. We're here to make profit. It's very simple. What options do we have though as traders? What methodologies? That's how it's known in the market, trading methodologies. In other words, what road are we going to take as a trader? These are some options here that we're going to be looking at throughout our webinars going forward. Like I said, I want to build a foundation, people to get an understanding before we start looking at more webinars, looking at these. So an investor wants to make profit. These are different methods which are well known within the market. First one is scalping. We've actually got a scalping webinar. I think it's next week or the week after, but it's definitely this month. I believe it's next week. Going to be an amazing webinar because it's actually going to show you strategies, real strategies, well-known strategies within the market on how you can open and close using this methodologies, using scalping methodologies, which you can use potentially and take into consideration. So what is scalping? Scalping is a methodology which is known as an ultra short method, short term, that is. So a scalper looks to open and close trades in a very short period of time with a small amount of profit. So instead of looking at opening a large trade, a large investment for a long period of time and looking to earn a lot of money, so for example, to keep it open for 1 year and earn 20%, they won't do that. Instead of opening one large trade with a large profit long term, they'll open a very small trade with a small profit target in a very short period of time. Scalpers mainly look at keeping trades open for a couple of seconds or a couple of minutes. And they very simply focus on the trend, not the longer term trend. They're focusing on their short term trend. Cannot be used for reverting short term reverting markets. Then we've got intraday, also known as day trading as well. Session trading, people know it as well. This is a short-term strategy, but not an ultra short-term strategy like scalping. This is when an individual is looking to open and close the trade within the same day. So again, the advantage of this is there's no overnight fees, there's no weekend risk, overnight risk. It's opening a trade, keeping it open a couple of minutes or a couple of hours, closing it before the session, before the end of the day. Now this, you can use it for both trading the trend and reversion, for example, mean reversion. But again, most beginner traders, they focus largely on the trend, because of course, when you've got a trend, most of the price movement is in favor of the trend. So rather than try and trade the smaller price movements, which are less and fewer, people concentrate on the vast direction of the market. Of course, it's down to you though to determine what the direction of the trend is and how long it's going to last and when it's going to change. And of course, this is also where we're going to be looking at future webinars. At future webinars, we look at different ways and methods of analyzing and determining this. Then we have swing traders. Swing traders, they are medium-term traders. They are open trades. It could be a couple of hours, it could be 24 hours, but it could be all the way up to 2 weeks. Not longer, it's not a longer term strategy, all the way up to 2 weeks. They trade both the trend and reversion, but they look to trade the whole swing, which I will look at going forward. Also a very popular method. The most popular, I can see people say, I've got a question here, what is the most popular? You know, it depends. I don't know what the most popular is, but keep in mind, CFD trading is short term. So, for example, intraday is very popular. Then you have news traders. News traders are short term. They want to trade when there's a lot of volatility being triggered by news. It creates big impulse waves, very quick corrections, and because there's a lot of volatility, there's also higher levels of risk, but there's also a higher level of seeing higher profits as well, potentially. So you have to balance the two. There's advantages and disadvantages to that. This is another option as well. People that want to trade the news, they tend to come to CFDs again because it's very easy and it's very quick to enter and exit the market. Then we have methods of analysis. What methods of analysis are we going to be looking at? We've been speaking over an hour now, almost. Yes, almost over an hour. So let's go through our last few slides. We're going to look at some examples and then we'll end today's webinar. So technical analysis, very simply analyzing the price, price patterns, and technical indicators. I'll give you an example on the next slide, looking at technical indicators. The scalping webinar will look at how to use technical analysis to determine how the market is going to move using the scalping methodology. But technical analysis is analyzing the price, analyzing patterns, price patterns, and analyzing technical indicators. So for example, if somebody's looking at an option to buy a house, maybe your first residential house, and you can see 10 houses, all of them are the same, more or less. One of them is worth $100 dollars, 9 of them are worth 100 US dollars, but one is worth 90 US dollars, you may say, that's a good deal. I'm going to purchase that one. You've just done technical analysis because you're analyzing the price. Then you have fundamental analysis. Fundamental analysis is, for example, like the correlation. Analyzing is when you're analyzing aspects of the market which is going to affect the price before the price movement happens. So what is causing the price to happen? Cause the price to change? It's people buying and people selling. This is what is causing the price to change. Fundamental analysis is saying what is going to happen within the market, which is going to trigger you to buy, trigger you to sell. Now, if you're able to determine this, then you are able to determine how the price is going to move before it moves. That doesn't mean it's more important than technical analysis, because you may determine that this aspect of the market is going to trigger a stock market crash, but you don't know when the stock market crash is going to happen. So you still need technical analysis, because you may determine the stock market crash is going to happen and instantly sell, but over the next 2 months, there's a strong upward trend, and then there's a stock market crash. So because you didn't use technical analysis, you missed out and sold at the wrong time in the market. So you had to use all three methods because they complement each other. So what do we look at when looking at fundamental analysis? We look at economic data, we look at political developments, geopolitical aspects of the market. Also for commodities, we also look at the environment, because of course the environment can have an effect on the price of commodities as well. And then the last but not least, probably the most important, probably the most difficult, probably the most helpful is order flow analysis. Order flow analysis, when you use tools which basically show you how many buyers there are in the market, how many sellers there are within the market, and where pending orders are within the market. So what are pending orders? Basically, it's saying that the value now is at, let's say, 100 US dollars, maybe a stock. 100 US dollars is the value of the stock, but there's a pending order. So there's an order that says, if the price increases to 110 US dollars, I want the platform to sell and I want to cash in my profit. So it's tools which show you how many orders and where are the pending orders. So for example, there's a lot of orders at $110 to sell. I'm not going to go at $110 and buy, because I can see everybody's looking to sell at that price. This is just an example. So this is the idea behind order flow analysis. It's largely used by institutions and professional traders. I want to give an example of technical analysis. So on our left here, we have two indicators. We have here a moving average. There's a 75 bar exponential moving average, and here we have a relative strength index. They help people to determine if the price is going to increase or decrease. For example, if the price, you can see here there's three numbers, there's 25, there's 50, there's 75. If the price, for example, is between for example, here is between 50 and 75, is indicating that buyers have control of the market. And you can see, since hovering above that, which was here, so about this area of the market, you can see indicates buyers are controlling the market, and we can see the price increased. Very helpful. Okay. Then we can see here the price is between 50 and 25, so it's indicating sellers have control of the market, and we can see the price decreased. If the price is below 25, it says it's too cheap. So you can see when it dropped below 25 here, price started to increase. If it increases above 75, indicates the price will start to potentially decrease. It's only an indication though, it's not advice, it's not guaranteed, it's only an indication. It's just a tool that we use as part of our analysis. We still look at other indicators, we still look at fundamentals, we still look at order flow. Then here on the right, ladies and gentlemen, we have a regression channel formed through multiple exponential moving averages. And we've got here a trend zone, retracement zone, correction zone. So again, that also can be significantly helpful when looking to determine how the price is going to move. So that's the idea behind analysis, determining how the price is going to move and within what period of time it's going to move. Then we've got fundamental analysis. I've got a question here. Quickly answer this question. So I've got a question here. Is leverage applicable to everything trading procedure? When you say applicable to everything, are you referring to applicable to all assets? If so, it depends on you. It's up to you if you want to trade with leverage, how much leverage. You can, if you wish, have it applicable to all assets. I've got another question here. Okay, so I've got somebody who says, if you can tell me one thing, what would it be? What I will say is, the market is volatile. Even when you're looking at a trend, there is volatility. So for example, here we can see there's an upward price movement. When there's a lot of price movement in one direction, you should expect a retracement. So for example, here we've got a lot of upward price movement. Doesn't mean because there's a lot of movement in that direction it's going to collapse, but you should expect some kind of retracement. So for example, even without using indicators, a lot of price movement in one direction, you should be cautious that it's going to start to decline at some point. May not decline to the previous price, but start to decline at some point. And then as it starts to decline, people may be re-attracted to it. So people rebuy. And that's what creates that up, down movement. So that wave. So that's very important. The other thing that I will say is it's very important as a beginner to consider. It's not advice, completely down to you how to trade. But there's benefits to beginners only trading one asset. Doesn't mean you trade less, doesn't mean there's less profit available to you. But if you trade one asset, it means in 1 year's time, your knowledge about trading and that asset will be vast. Whereas if you're trading 10 assets or 5 assets, or each day you're trading a different asset, your knowledge in 1 year is going to be minimal. Whereas if you trade one asset and you're concentrating on one asset alone, in 1 year's time, your knowledge will be vast, which is of course what we want to see from our traders. So I've got a question here. Can we have a practical session where we can visibly see trades? We have a live analysis webinars. These live analysis webinars, we analyze the market together using indicators. It doesn't give advice. So I'm not going to say to you, buy here, sell here, or this is likely to happen within the market, but it's a live analysis session. So this is what you're referring to. Yes, those are available. You can see those on our website. Got another individual. I don't think 1 hour can cover the whole training topic. Keep in mind, guys, this isn't going to cover trading. It's just a foundation. To build that foundation, it's just an introduction. We're not going to look in detail at each one of these topics. This is just an introduction to show you what we're going to look at in more detail in our next webinars. So keep this in mind. We're not going to look at this in vast details, just an introduction. Is it advisable to trade where there's high volatility? It depends on you. No correct answer to that. Depends on you, your method, what you're looking to do. Of course, where there's higher volatility, there's potential for higher returns, but potential for higher losses as well. So that's important to understand. If we can look at support and resistance in more detail, again, this is something that we're going to look at in the webinars where we're concentrating on technical analysis. Today, again, because we've only got a limited amount of time, Unfortunately, we can't cover everything, but it is definitely going to be included in technical analysis webinars. Okay, so that's all questions by the looks of it so far. Right, so fundamental analysis. What I want to show people is a good example, just an example, because we've already looked at what fundamental analysis is. This is the German DAX. This is German DAX last month. Here you can see sideways price movement. There's up, down price movement, some volatility, nothing major. Then wham, we get a lot of volatility. Even after this volatility, the upward trend continues. What is triggering that? This is fundamental analysis. So on this day, ladies and gentlemen, German, French, and Spanish inflation data came out. For all three regions, inflation was lower, which is good for the stock market. Because of that, we can see this amazing upward trend. So no matter where you're buying, if you bought here, or you bought here, or you bought here, this is an amazing trend. It would have been an amazing trade, no matter where you were buying in that bracket there. And we had determined this because we were following fundamental analysis. Order flow, just want to give you an example. We're not going to look at it in too much detail, ladies and gentlemen, like I said, because we're limited for time. Order flow analysis here. So this is basically a chart that shows you how many buyers and how many sellers within the market. For example, here, this third row here is very important. It shows you per candlestick, is there more buyers or more sellers? So you can see here, all of them are red except this one here. So in all these candlesticks, only one of them had more buyers than sellers. So if somebody's saying to you there's more sellers than buyers, are you going to buy? Obviously not. And because you've got that information, you can see that the price is declining. And you could have benefited and determined this from order flow analysis. And again, I just want to show you an example. We don't want to go into detail on order flow analysis. I just want to show you an example. Let's build the foundation before moving on to our next webinars. So creating your trading plan, very quick basics before we end today's webinar. Creating your trading plan. Which asset, this is what you need to think about. We're not going to build a trading plan now. That's going to be included in another webinar, but this is just getting your brain thinking about a trading plan, thinking as a trader. Which asset are you going to trade? This is the first thing. And like we said, there's benefits to only trading one asset. Which asset are you going to trade? Trade that asset, stick to that asset, stick to the trading plan. Don't switch assets. Next thing, what session are you going to concentrate on? So for example, if you're trading NASDAQ, which is one of our most traded assets, of course, there's benefits to trading the US session because that's when that market is open. And of course, you want some level of volatility there. So what session are you going to concentrate on? So far, you know what you're going to trade and when you're going to trade it. Something also to note, if you're trading something which is related to sessions like stocks, ETFs, and indices, keep in mind trends within the first half an hour are deemed to be high risk. So you want trends to be holding on for more than the first half an hour of the session, not holding on for half an hour. So if the session is halfway through, you're not saying to yourself it needs to hold for half an hour. I'm saying the first half an hour. Be cautious of those price movements because a lot of the time, the first half an hour can shoot up and the rest of the session just decline. So be cautious of that first half an hour, and also keep in mind in the last the last 2 hours of the session, volatility is very low. A lot of the time, stocks can also either lose momentum and trade sideways or actually decline. Why? Because it's the end of the session. All these day traders exit the market. So you know what you're going to trade, when you're going to trade it. Trade size. What is the appropriate trade size for you? Some people, for example, follow the 1% rule. So if I'm opening a trade, I shouldn't be exposing myself more than 1% of my account. So if I've got $500 in my account, my trade shouldn't be more than $5. Okay, just an example. So we know how much we're going to trade, what we're going to trade, when we're going to trade it, and how often to trade it. Stop loss, take profit. Very simple. When you open a trade, so for example, we may see a price movement like this, you may look to open a trade here. You can set automatic exits. So for example, you may say, I'm going to exit here automatically, and I'm going to exit here automatically. So this may be my stop loss, and this may be my take profit. So if the price declines to here, the market will automatically exit the trade and there's no more risk for me. If it increases in value and it hits my profit target, amazing. It will close the trade, it will cash in into my account, the original investment, plus my profit automatically. So I can sleep careless with no fear because I've got my stop loss and my take profit. Then also, this is very important because it also confirms the reward to risk ratio. So you know how much you're going to earn per trade and how much you're going to potentially lose per trade. So you know what type of performance is going to be per trade. Then what you need to look at is the success rate. So you should know in a week, I'm going to open 10 trades. The trades that are in a profit, this is how much they're going to be in a profit. The trade in a loss, this is how much they're going to be in a loss. So you know what success rate is required in order for you to be profitable. It's all about mathematics, not about the market. If you know what your success rate is and it's consistent, and you know your stop loss and your take profit, and you're always opening the same trade size, it's a matter of mathematics. You know what stop loss and take profit is needed based on your success rate and vice versa. Know how to enter the market. This is what we're going to be looking at going forward. How to determine how to enter the market and what type of method you're going to be looking at. So you need to know these. You need to practice it on your demo account and then look at it on the real market itself. Please, how can you get materials to us? Of course, I'll send this, of course, to everybody within the next 24 hours. So you will get the PowerPoint, the PDF. You'll get a copy of the recording as well, so you can relook at this. That's the end of today's webinar, ladies and gentlemen. I've got a question here. By the way, if anybody's got more questions, this is the time to ask. I don't understand this question. Is it advisable to trade when he or she realizes the market is really amazing? What do you mean by this? If you can please clarify. Of course, I will answer the question. Got a lot of thank you. Guys, you don't need to mention thank yous. It's great, of course, to have these sessions with you all. So I've got an individual here. Can you please explain the functions of support and resistance in technical analysis? So keep in mind, it's not as part of today's webinar. For this, really, you need to look at webinars based on technical analysis. But I'll answer the question to the basic standard level. There's two types of support and resistance. You've got support and resistance based on prices, and you've got support and resistance based on oscillators. So, for example, you can use oscillators to determine when the price is overbought and oversold. If it's overbought, you're at a level. Doesn't mean it's not art where there's a line and you need to stay within the line. The market doesn't work like this. So it's at that region, that price level, that somewhere around that level, the price is going to find resistance. Now, resistance doesn't mean it's going to be a new trend. It could be just a loss of momentum. It could be the price is going to continue moving upwards, but with less momentum, less movement. It could be a retracement, or yes, indeed, it could mean the end of the trend and a new trend. So you need to take it into consideration as part of your trading, but it shouldn't be the basis of your trading unless you personally think it's that important. So for example, you need to keep it as part of your analysis because you need to look at what the true value is of the assets. Is the value really trading above its value? Should I be buying at the point where it's already collapsed on 4 occasions? Because of course, if it's collapsing continuously at the same price, then really we're looking at traders building that psychology of, is it going to collapse again? Maybe I should avoid it. So this is something that we keep into consideration as part of our analysis. But again, really, we need to look at this in more detail. It's a very big subject. And of course, we will have specific webinars specifically based on this. How can I put a stop loss on the MT5? If you open a trade, right click on the trade, click on modify, you can see there's a stop loss and a take profit. Other options is you can click on orders, charts and then orders, and there's an option there for take profit as well. So both for stop loss and take profit. Yes, guys, I definitely will send you a recording. Please clarify the difference between trend and reversion. There's a trend in markets which has higher highs and higher lows. This is a trend in market. So there's always the impulse wave, corrective wave, the impulse wave, corrective wave. Always, a trend will always have impulse corrective waves. If you're looking at a trend, the highs are consecutively higher and the lows are also consecutively lower. When you're looking at a reverter market, there is no higher highs, higher lows, consistent. So you get both impulse waves, which are both up and down, and it creates that trendless market. What is your suggestion for the reward to risk ratio? Again, we cannot give suggestions, we don't give advice. What I will say is the reward to risk ratio will depend on your success rate. If you've got a high success rate, you can be less generous with your reward to risk ratio, for example. So for example, if you've got a high success rate, you don't necessarily need a high reward to risk ratio. You can allow the market more time. Because you've got a very high success rate. So you're rarely going to close a trade in a loss. Whereas if you've got a very low success rate, then you need a high reward to risk ratio in order to be successful. But again, I cannot give advice on what. So on what the reward rate to risk ratio should be, because it depends on you, it depends on you as a trader. When's the next seminar going to be? Next Tuesday and next Wednesday. Okay, let's look at the last question. When do you advise I go live? I cannot advise, but I would say, generally speaking, people tend to feel comfortable going live when they're already successful on the demo. So hopefully that answers your question. So ladies and gentlemen, let's end today's webinar. Trade safe, trade responsibly, and hopefully we'll see you very soon on our next webinar. I have a next webinar next week. You can go on HFM Markets, click on education and click on webinars, and you can see when my next webinar is, of course. Next week, I believe we're looking at scalping, which is less general and more specific on how to be profitable, how to trade. When I say profitable, not profitable, how to trade and attempt and try and be profitable using the scalping method. So let's end today's webinar. Trade safe, trade responsibly, ladies and gentlemen, and hopefully we'll see you very soon on our next webinars. In the meantime, goodbye.